Hello, everyone. Thank you for joining us today for our webinar where we're going to be talking about estate planning considerations when taking into account the economic impact of the pandemic and COVID-19. My name is Mark Heath. I'm a partner here at McKonly Asbury and Director of Tax Services. With me is Trimarchi, Managing Partner, and Eric Blocher, Principal and Director of Business Valuation Services. Before we get started, I do want to mention if you have any questions for us during the webinar, please submit them through the built-in questions function, and we will do our best to answer them during or after the webinar. There will also be 3 polling questions throughout, so be sure to answer those if you are looking to obtain CPE credit for today's webinar. Quick firm overview. We're McKonly Asbury. We're about 100 professionals across 3 offices. We provide advisory and business consulting, audit and assurance, entrepreneurial service and client accounting, internal audit, professional placement, and tax services to all sorts of industries, including healthcare, employee benefit plans, family-owned businesses, nonprofits, manufacturing, distribution, construction, and affordable housing. Before we dive into the estate planning aspect of this, we did want to take a few minutes to discuss what all businesses need to be thinking about in terms of planning for future income tax changes. In all likelihood, and under many scenarios, there's going to be some significant income tax changes coming. Before we get to that, let's quickly go over where we are right now. Today, the maximum individual income tax rate is 37%. That was put in place by the Tax Cuts and Jobs Act that was signed into law in late 2017, taking effect in 2018. This was a decrease from the previous max rate of 39.6%, and also built in there are some preferential rate brackets. Also included in the TCJA was the QBI deduction, or 199A deduction, where you get a deduction of 20% of your flow-through business income. There's a number of restrictions on that, but obviously this one's very popular and was meant to make flow-through businesses taxed on a level on par similar to C corporations, since C corporations got to drop down to 21% from a max rate of 35%. The maximum capital gains rate is 20%. That's been unchanged for a number of years and is not slated to change. And the state tax exemption, which Eric and Kurt will be talking more about, is $11.58 million right now, and that's indexed inflation, so it's going to go up every year. And like we said, the C corporation is a flat rate right now of 21%. So then the next obvious question is, where are we going? The one catch with the TCJA was that the way they had to pass it, if you recall, they had to pass it in what was called budget reconciliation. They did not have 60 votes in the Senate, so they had to pass it with 51 votes, which means they had to let a lot of the benefits expire. Otherwise, you'd blow the budget, and you're not allowed to do that. So all of the individual income tax provisions contained in the Tax Cuts and Jobs Act are slated to expire after 2025. What that means is, if we don't have future legislation, they're going away. That is one thing we can be certain of. And so, so we say, well, what do you mean absent future legislation? Why don't they just act to permanently extend it? It's kind of obvious right now. Congress has a very difficult time agreeing on pretty much anything. So absent some big change here in the next couple years, we can't imagine that a lot of this, any of this changing. The easiest thing to do from Congress's perspective is just to basically kind of just sit on your hands and do nothing, let all of this expire. It's not popular, but their hands are kind of tied, because most likely you'd need 60 votes in the Senate to make any and all of these individual income tax provisions permanent, and we just simply don't see that happening under pretty much any scenario. So that means in 2026, the maximum individual income tax rate will most likely go up to 39.6%. The QBI deduction goes away completely, so that just goes to 0. Our max capital gains rate, like we said, that's 20%. It's been 20% for a while. It's going to slated to be 20% for a while. The state tax exemption would drop back down to $5.5 million. The one thing that is permanent in all of this is the 21% C corporation tax rate. And one question we get a lot is, why did they make the C corporation tax rate permanent? So, you know, while people think of the big companies as being C corporations, they're paying a lot of tax, and company by company, they are paying a lot of tax. The total revenue collected by the federal government in income tax, a very small percentage of that, it comes from C corporations. So dropping the rate from 35% to 21%, while it made C corporations much competitive on the world stage, it didn't drop U.S. tax revenue dramatically enough that they couldn't make it permanent. So that's why that piece is permanent. So now you're going to say, well, okay, this doesn't happen until 2025, right? We got plenty of time. I don't even need to be really thinking about this. So not so fast. No matter what happens in November, no matter what happens next year, we think there's big potential for an income tax increase coming either in 2021, 2022, and no matter who's in the White House. So why do you say that? Obviously, this year with the CARES Act and the provisions in the FFCRA, there's just massive government spending. And when I say government spending, obviously there is a lot of spending, but there's also a lot of decreases in payroll tax collections, payroll tax deferrals, and just the decline in the economy in general. We had the largest decrease in GDP in U.S. history. Tax revenue is going to drop dramatically. So at what point, no matter who's in charge, are they going to be faced with saying, well, do we have to increase income taxes so that our budget deficit doesn't just grow exponentially, even more exponentially than it already does in the next few years? So the Biden administration, or a potential Biden administration, they've clearly stated their desire to increase income taxes, both individual and corporate, at least on the individual side, at least on higher earners, and corporate. So they've talked about increasing C corporation income tax rates to 28%. I think they would kind of if they increased individual income tax rates, feel like they'd kind of have to increase the C corporation tax rate, because they would get a lot of pushback on that, because obviously C corporations aren't seen as people. Even though they're made up of people, they're not seen as people. So to increase individual income tax rates without increasing C corporation tax rates, it's a real question of, you know, would that be okay? Would people be okay with that? Most likely not. It wouldn't be seen as fair. They'd probably have to do both sides of it. The upside of all this in terms of taxes is, in order to have something crazy, like, and what I'm going to call crazy is completely repealing the Tax Cuts and Jobs Act early. In order to do something that dramatic, they would most likely need to control the Senate. They would absolutely need to control all three houses of both houses of Congress and the White House. They would need to control all of that. Will that happen? Sure, it's a possibility. I don't see them getting. I can't imagine they would get a filibuster-proof Senate. And so it would be very difficult for them to do something, you know, what we would put into the category of really crazy in terms of income tax increases. But clearly, Biden has said he's okay with increasing income taxes if he's in the White House in a few months. The Trump administration, they say they want to make everything in TCJA permanent. We don't see that happening because they would need 60 votes in the Senate. And when, you know, there's going to be enough Republicans at some point in time who are going to be budget hawks, who are going to say we need to figure out how to at least close the gap in the budget deficit. So are they going to be okay with increasing income taxes? Both of those we see as fairly possible scenarios. So then the question is, you know, do you accelerate income? I've been doing this for 20 plus years, and just the whole idea of accelerating income when it comes to income taxes is just insane. It's reserved for very rare scenarios, and it has really only come into play here now, where we have kind of this flux in environment of income tax rates. When you look at the numbers, it makes a whole lot of a lot more sense, and really starts to beg the question: should we really be considering this more than we already are? If you look at the maximum individual income tax rate potentially of 39.6%, you compare that to the maximum current individual income tax rate when taking into account flow-through income. That's what we're talking about here. We're talking about businesses. We're not talking about just payroll and W-2 income. That rate is 29.6%. So how do we get 29.6%? If you just take 37%, the maximum individual income tax rate, factor in your QBI deduction of 20%, that drops it to 80% of that 37%, which equals 29.6%. So that gets us a 10 percentage point potential permanent tax savings for every dollar of income that we can accelerate into 2021. So you have $100,000 of income that you can push into 2020. In 2021, the individual income tax rate reverts back to 39.6%. You've already sheltered that $100,000 in 2020 and saved $10,000. And obviously, as the income number gets bigger, the tax savings gets bigger. For C corporations, if we go to 28%, you're going to get an immediate permanent tax savings of 7 percentage points. So this is what we need to be thinking about. This is what we need to run the numbers, talk about the calculations, to see what do we want to do. So then the next question is, well, how would I do this? The easiest lever to pull is just bonus depreciation. So right now, bonus depreciation for fixed asset additions with lives of less than 20 years is 100%. You don't have to do that, though. You don't have to take that. You can elect out of bonus depreciation, and depending on the life of the asset, spread the deduction over 5 years, 7 years, 15 years, whatever. So that just pushes off, it defers your deductions, pushes your income into 2020 compared to what you could have taken. That income gets taxed at a net rate of 29.6% or 21%, as opposed to that income being taxed at 39.6% or 28% a couple years down the road. That's simply the easiest lever to pull. But we do have to remember the phase out for bonus depreciation begins in 2023. Other easy levers to pull: do you pay bonuses on March 16th? Normally you pay bonuses, year-end accrued bonuses on March 15th. Do you pay those on March 16th? All you got to do is wait a day. And once you get out of that March 15th window, they're no longer deductible in the previous tax year. So that's an easy one right there. Do you accelerate cash collections? If you're a cash basis taxpayer and you have a receivable sitting there, can you call that customer and say, hey, would you mind paying, just a day early or whatever, get it in 2020, get it taxed in 2020 at a potentially lower rate? Do you hold off on paying accruals? We talked about bonus depreciation, accrued bonuses, but you can do this with anything. Do you just wait a little bit to pay those accruals so that you do not get the deduction in 2020, you get the deduction in 2021? Other thing, PPP loans. So I know we've talked a ton about PPP loans here in the past 4 or 5 months. Everybody wants to get them done off their books, forgiven in 2020. Is this even more of an incentive to do that? Because right now, if you remember, the loan forgiveness itself is not taxable, but the expenses that you pay right now under current law, the expenses you pay are not deductible. So that's going to be an income event whenever you get it forgiven. So do you want to make sure to get that forgiven in 2020 as opposed to waiting until December or whatever and getting your application in, and then the bank doesn't approve it until 2021, ends up being a 2021 income event? All of it, these are all things to consider. Now, clearly, this is a roll of the dice. It's a calculated risk. Things you need to consider. Do you have the cash flow to do this? Obviously, in this economy, cash flows down across many industries. Do you have the cash flow to do this? You need to calculate your rate of return. So if I'm going to pay more tax now than I have to, is that permanent tax savings of 10 percentage points or 7 percentage points? Am I going to do better on that as opposed to not paying the tax now and paying more tax later? If you have a large shareholder group, if you're a family-owned S corporation with 25, 30 family members as shareholders, what's their average income tax rate? Because we keep talking about the maximum rate of 37%. If you have taxable income spread across a large shareholder group, you might have an average tax rate of 25%, in which case your savings just aren't going to be that great, probably not worth it. If you're currently looking at an NOL for 2020, it's almost certainly not worth it, since right now with the CARES Act, we can carry NOLs back to years where tax rates were most likely higher than they are right now, or at least the same as where they're going to be in a few years. So clearly this is not for everyone. But if you're not thinking about it and you're not looking at the numbers, you're doing yourself a disservice. There's a whole bunch of factors to consider here, but we're happy to talk about it. If you do want to talk about it more, we want to make sure we give you every opportunity to plan around potential changes. If you have any questions, if you want to go through this exercise, please do not hesitate to contact us. We would be happy to walk you through it. So that's it on the income tax side of things, which brings us to our first polling question. So everybody out there, if you are here for CPE, make sure you are paying attention right now. We have our polling question. So here we go. Have you considered deferring expenses or accelerating income in order to hedge against rising tax rates? Yes, no, or the ever traditional popular example, why would I ever accelerate income? Feel free to chime in. If you have any questions on this, you can put them in the chat box or the question box, and we'll get to them if we can. And like I said, if you want to talk about this more, we're here. Just give us a call, shoot us an email. Polling question is going to be up for probably about another 30 seconds. I'm used to having Dave Blaine here, but we're getting dead air without Blaine. What's going on?
I don't want to talk over you, Mark.
We've never stopped Dave.
Oh, that's a good point.
All right, about 10 more seconds on that polling question. 5, 4, 3, 2, 1. All right. Oh, very interesting. We're about 50-50 split almost between yes and no. That's good. I'm glad to hear companies are considering this. It's definitely something, like I said, if you're not at least thinking about this, you're doing yourself a disservice. So now I'm going to turn things over to Eric Blocher, our resident expert on valuations. Take it away, Eric.
Oh, thank you, Mark. As Mark said earlier, Eric Blocher. I'm the principal with McKonly Asbury, and I lead our business valuation practice. And I wanted to go over a couple of things about business valuation to kind of lead you into it. Some things that you need to be aware of that'll, I think, frame the whole discussion that I'm going to have. The first thing is that a critical tenet of business valuation and determining value is that it's a forward-looking exercise. It's an expectation of future returns. And during this presentation, I want you to consider yourselves as an investor, and an investor in any business. So what you're really looking for is the return on your investment from the day you buy it going forward. The past is not as important as you think. The past may be an indicator of what's going to happen in the future, but it's really not that important. If you think about, I always bring up the example of Blockbuster. Blockbuster fell down and declined in value pretty quickly. Towards the end, you couldn't look at the strong years of Blockbuster to determine the value of the stock or the value of the company. You would need to look forward, and you would see that the shops were closing very fast, and that the outlook didn't have a lot of value going forward. So that's the forward-looking aspect of business valuation. And the second thing that I want you to think about is an investor is going to look at estimated returns and the risk of receiving those returns. So you see that there's cash there, but there's risk of getting the cash. And that is something that I can't stress to you enough the importance of. And there's an example that I've used before in presentations I think puts it in a pretty good framework. So I want everyone out there to consider yourself that you're a thief right now, and you're considering investing in two separate projects, as a thief. And both of those projects have the same return at the end, but there's a little bit of risk difference between them. So the first project is you're given an envelope with an address on it. And the second one is an envelope with an address on it too. Each of those houses, those addresses have $500,000 in cash in the house. But the first house, a 79-year-old man lives there. He's living by himself. He's hard of hearing, and he uses a rascal to get around anywhere he's going. So that's the first scenario. Now, the second scenario is you have a 23-year-old kung fu bodybuilder living there. He has one Doberman, one Rottweiler, one pit bull, and he only feeds them one time a week. Oh, and I forgot to mention, he's a gun enthusiast also. So between those two projects that you have, one has a little less risk and one has a lot more risk. So when you as an investor are considering the same cash flow, result, you have to factor in the risk. And that highlights something that I think is really important to business owners and investors, is that risk really matters. So if you're the thief here, obviously I'm going for the old guy. Also, next thing is that time value of money is always considered in business valuation. It's the old adage that $1 today is worth much more than $1 2 or 3 years down the road. And that's always factored in to every business valuation. Okay, next slide. Okay, now what we have here is a Gordon growth model. This is a simplified equation that can be used to help understand how values arrived at. It's simplified, it can get much more complex, but for our purposes, you want to look at this equation here where the present value would be the present value of the business or the value you're trying to determine equals the expected cash flow or the return on the investment, and this is just in period 1, that return divided by a risk-adjusted discount rate or cost of capital. It's basically the required return that you need to get on an investment. And the required return is always specific to the investment. And for valuation purposes, the required rate of return is specific to the business that you're valuing. So then you also need to factor in the long-term growth that's expected for the business. So to keep it simple, remember there are two parts. There's the numerator and the denominator. Changes in either of them impact value, and COVID-19 can impact both cash flows and the required rate of return. Okay, next slide. So as cash flow increases, the top number increases, value in the company increases as well. As growth increases, value also increases, because that means you're going to be getting, if you're growing more, you're going to need more cash flow in the future, so the value of the company increases. But as the required rate of return increases, value decreases. Think of it like that example I said, that the required rate of return or risk of not getting the returns between the two houses, the old man versus the kung fu guy with the dogs and the guns, the risk is there, so it's not worth as much. So as the required rate of return increases, the value overall decreases. Risk increases, the required rate of return, and most businesses have far more risk than they realize. And this is even before COVID-19 came into play. But generally speaking, COVID-19 has further increased the risk to businesses, and in many cases, it's reduced the cash flow. So it's a double whammy and a double impact of value in some instances. Okay, so now you have the background on how we would consider and look at value. We're looking at the cash flows. Now, COVID-19 comes along, and there's a lot of questions when you're looking at valuing a business. I'm on several boards, valuation committees and boards across the state and across the country, and one of the questions comes up in all of our meetings is, what will a recovery look like? Now, no one has the answers, but there are so many questions that need to be looked into, and the answers to these questions, I think, can impact any valuation on the company that you're doing, because it can impact cash flows. I mean, what will it be? Will it be a full recovery or only a partial one? No one knows the answer, so you really need to dig in and look at the industry, factors. What's the industry outlook look like? Specifically, what is management's plans to address it within the company you're valuing? How are they being impacted now? When did they see a recovery? How long until recovery begins? 1 year, 3 years, or even longer. I've heard estimates ranging that whole time frame, but no one really knows. And it does vary by industry. Some industries are not as impacted as others. And so recovery can happen sooner for some industries than later for others. And we're beginning to see estimates of how long it may take different businesses and sectors to fully recover to pre-pandemic levels. And for some sectors, it's not good. There's a company out there called McKinsey & Company, which is a global management consulting company, and they came out with a survey or a study called U.S. Small Businesses Recovery After the COVID-19 Crisis. And what they did is they looked at 18 individual segments of business, and they estimated how long the recovery, how long it would take to begin, and then how long it might end. But they estimated for these 18 segments that with a full recovery, they assumed the virus is contained, that it would take anywhere between 1 and 3 years for a full recovery to occur. And then if there's a muted recovery scenario, which means that there's second wave or quarantine start happening again, that recovery can take anywhere from 1 to 5 years. And that is a significant time if you think about reduced cash flows for a business. That can have a dramatic impact on any business if revenue's not there, if they don't have, they can't operate the way they've been doing. So no one really knows what a recovery is going to look like, and it's impacting the values of almost any business. Next slide. Another question is social distancing, quarantines, and gatherings limited to a certain size, is that the new normal? I've been talking with my wife about schools and everything that our kids are going back to, and we don't really know what the new normal is. They had to make changes just because they need to maintain social distancing, and we're thinking, is this going to be going on forever? Businesses have to do the same thing. Many businesses face reduced demand and new operational expectations and challenges because of health and safety concerns. If you think about it, you have masks that have to be worn when you go into a business. You have non-contact interaction. If you go to a grocery store, you have to stand 6 feet apart. You have to, clean everything off. You have the distancing between workers too. So if you're a manufacturing company and you have to maintain distancing for workers now where you've never had to, it can change your whole production line. But businesses are facing new challenges they've never had to before. It's not going to be easy, to get past those, especially if this is the new normal. And if it is, the profitability and cash flows might be capped at levels below pre-pandemic levels. Like if you think at restaurants and sporting events and hotels, right now there's government orders vary by state to either close down to operate for certain time periods, or you can operate at a certain percentage of capacity. If you're a restaurant, you're only allowed to seat 50% of what you were before, and your revenue is capped at 50%. That certainly has an impact of value, and many of them can't survive this. But how long will that go on? It goes back to the last question: is when will a recovery happen, and will these new norms go away? But in the meantime, they're facing a lot of challenges and things that are really causing businesses to struggle at times. They may need to seek new and alternative ways to generate revenue. If you think about restaurants that have not offered delivery before are now offering delivery. They're offering curbside pickup, and I don't know if you've seen it, but I've seen a lot of seats in parking lots then too. They're trying to expand their footing to get where they can have more revenue coming in because they can't have everyone seated where they used to. Sporting venues, I've seen where they are renting out their parking lots and having people come in to pay an admission to drive in to see live concerts over the radio, or drive in, watch a big drive-in screen over the radio. They're looking at new and alternative ways to make revenue, and they're going to have to survive because they're faced with changes that they can't operate the same way that they've been doing. There may be additional costs of doing business under any new normal, like new technologies, additional cleaning supplies, health and safety gear, things like that, where your cost structure might not be the same. So COVID-19 came in, and now all of a sudden you have to be supplying personal safety gear to everyone. You have to have new scanning tools coming in for inventory, maintaining it, or cleaning supplies cost dramatically increased. We have to clean everything down every night. Businesses are operating under different cost structures. You got to figure out what that cost structure is and then make an estimate of how long it's going to continue. All these things are new factors that are facing the businesses. The hard fact is many businesses may not be able to reopen, due to COVID-19. I've seen, unfortunately, several businesses in my area close. The cash flow is not there, and the demand is not there, or they're not allowed to operate. Movie theaters. We weren't allowed to have the seating in the movie theaters, and they haven't been able to open yet. There haven't been any new movies released in ages. But the movie theaters can't survive. They can't make their fixed rent payments and other payments that they have, so they're just closing the doors. But the question is, and things that need to be answered from a valuation perspective, is does a thin competitive market actually help the businesses that survive? If you're a local restaurant and you say you have 10, 15 competitors, now 7 of them can't make it because they can't find the alternative revenues, or they weren't able to survive because they didn't have enough reserves. Now, once the market opens up, are you going to have more revenue because there's less competitors and more people will be coming to your business? That's a factor that you might want to think about, that we as valuators need to think about. Does a less competition result in more revenue and profits, or has demand been reduced to levels that offset competitive gains? We've seen people may not want to go out to some restaurants or other places where there's a lot of, there's not social distancing. So demand for your business might have been reduced, to a level that even if you're surviving, they're still not there to maintain the way you were before. Would an increase in revenue and profits be offset by new operational costs and challenges? Those are difficult questions. I've talked with management of some of the firms that I value, and they're facing challenges and factors that they haven't run into before. And so even some of the ones I valued are doing well, but they have new costs that they didn't know about. It just makes projecting the cash flows, the future cash flows that you as an investor are looking at, or as a business is being considered to help determine your value, it makes determining that really difficult. You don't know when a recovery is going to begin, how long it's going to take to a full recovery, if there will in fact be a full recovery. And if so, then what additional costs are you going to have that you didn't have before? It just makes projecting the cash flow and income extremely difficult and challenging. Some businesses have been positively impacted by COVID. It's not all doom and gloom out there. I have a couple clients, that are in the food industry that have had record years, but it doesn't make it necessarily easy, on the valuation of it, because you need to factor in that how long is that boom going to last? The second bullet point here is, will the increases carry forward into the future? Like, is it a new baseline, or will revenue regress to pre-pandemic levels? Those are factors that are not easy to answer. Several companies, if we're a toilet paper manufacturer, I'm sure you had a fantastic year, but I don't think you want to project your revenues from this increased baseline, because I think at some point, toilet paper is going to be available and people aren't going to be hoarding it anymore. I just need to convince my wife of that. But that's a factor that you need to consider for every industry that you're in. Manufacturers of personal safety gear and cleaning supplies have also seen a surge in demand and revenue and profitability. And short term, it's good, but long term, it makes it difficult to see if this is, like I said, if this is a rising tide that will always be there, or if it's just a one-time increase in profits. And how you determine which is more likely. Did you gain some brand loyalty if you were able to supply, food that people couldn't find out there? If you were one of the brands that was still able to do what you could, and now do you have new customers that will always be new customers, or was it short term? It's difficult to determine, what you need to factor in for future projections. Okay, now COVID-19 shined a light on new risks associated with doing business. We had government-imposed shutdowns, limitations on operating capacity, new safety measures, reduced workforce if there's a positive test. All of these things were not really looked at in depth when determining your required rate of return from when we did valuations before. It was out there, but we had never seen or been through anything like we've been through now. So these new risks, we're made aware of them. You know, what happens to a business's reputation if they find out that people that work there tested positive? You know, and there are more cases. They have to temporarily shut down for a while, but then the reputation, will people still want to go to these restaurants, if you're a restaurant or so, because you had an outbreak of COVID there? You know, those are questions that are difficult to answer. You know, these risks may not have been considered when we previously developed the required rate of return, but you keep in mind that more risk equals a higher required rate of return and a lower value. And there's a lot of risks out there that we now need to factor in, like a risk of a second wave. You know, that is something that can be very real, and people are facing it out there. I know this school year for my kids looks a lot different than the last school year did, because there's new risks they have to face and they have to do business differently. There's also a risk of downstream suppliers not having inventory. You know, a couple factors. You know, if a business relies on foreign parts or inventory for them being a reseller, they may not even have the inventory to sell. So it could be a long time before they even can operate back to normal because of restrictions on imports. There's just a lot of factors from COVID that need to be factored in. And we ran into it, or my family did, when we were looking for a bicycle for my son. Now, I can't tell you, it was next to impossible to find a bike anywhere for a 19-year-old. I ended up having to drive, I think, 120 miles away to get the last bike that was in, because everyone, now that they were quarantining, was buying bicycles, and they couldn't get anything new in because the restrictions from trade were there. So most likely they were foreign produced bikes, but we had to wait. You know, once the supply was going, you have to wait half a year almost to get a bike. We ran into the same thing when we were looking for a refrigerator. Inventory was not available, so they could only sell what they had in, you know, when the quarantine was done. So refrigerator and other appliances inventories were extremely low because a lot of them had foreign parts they were waiting to complete the manufacturing. It's things like that if you're a retailer or reselling those, you know, appliances and bikes, you may not even have the inventory to make money. But those are factors that, you know, really make it difficult and are now risk. You know, when do you know that your inventory will be there, that need to be factored in to doing business going forward? You know, COVID-19, to sum everything up, COVID-19 has negatively impacted, you know, the cash flow of most businesses that we have and we've seen. It's increased the risk associated with most businesses. You have some that were, you know, the way that were, you know, they were organized, or they were suppliers of, you know, food or health and safety gear that had banner years. But for most businesses, there's always been negative contacts. You know, and if your cash flow decreases and you're riskier than you were before, they reduce the value of a business. And because of the reduction in value, we think now can be a fantastic time for a tax efficient, you know, estate planning transfers associated with the lower value of a business because of the factors from COVID-19. So I think it's time now for polling question number 2. So if you're here for CPE, please read this and answer. And as a youngster, Eric was scared to death of whom? The Land of the Lost Stack, the Wicked Witch of the West, the Child Catcher from Chitty Chitty Bang Bang, or George the Animal Steel? I wish I could have a picture of the answer here, and I'm very curious to see what you guys think. But there's definitely someone on this list that was a very real terror to me when I was a young child.
The sleeve stacks were scary.
Yeah, sleeve stacks were scary. They were. I would argue that all 4 of these were scary, but I think we have about 30 more seconds, or 10 more seconds. Yep. Okay. I'm getting indications that a lot of polls are being answered with 10. So 5, 4, 3, 2, 1. I'm curious to see what it is. Okay. Well, Land of the Lost Sleeve Stack. I loved that show. I wanted to be a sleeve stack. They didn't scare me. I wanted to go with Marshall, Will, and Holly, fall over that waterfall, and go talk to the Slee Stacks. So that wasn't the answer. The Wicked Witch of the West. She was pretty scary, but those darn monkeys scared me more than she did. So that's not the answer. Now, the child catcher from Chitty Chitty Bang Bang, if you're not familiar with who that is, it's a guy dressed all in black, and he had a really long, pointy nose, and he went around with this cage that tried to get kids to eat candy and lure them in the cage. He terrified me. So the answer is the child catcher from Chitty Chitty Bang Bang. He scared the willies out of me. Oh, thinking about it now still gives me shivers. And George the Animal Steel, I was a big professional wrestling fan. He didn't scare me at all. Okay. So now I think we're ready to move on to Kurt to talk about trust in the estates.
Good afternoon.
Thanks, Kurt.
Hope everybody's having a good day. Thank you, Eric. We'll try to take the remainder of our webinar time here to get through a conversation primarily focused on some trust planning, but we'll start out with just generally where the estate rules are currently. As I think we indicated earlier in the conversation with Mark, currently 11.58 million is allowed to be given per person and as a lifetime exclusion from their estate. So therefore over $23 million for a married couple. A significant change that came about under the Tax Cuts and Jobs Act that Trump passed earlier in or in 17. That's a significant deal. A lot of people say, well, as a result, I don't have a taxable estate. I don't really need to worry about it. I think if you have sizable assets, you still need to do estate planning. It's also foreseeable that that amount will go down significantly either in 2026 or possibly sooner, depending on the election. Tax rate at federal, if you have a taxable in, is 40%, so it is significant. You can also give $15,000 a year per person, or again, $30,000 per couple, to as many people as you want every year, and not pay tax on that. And as I mentioned, when they're set to expire, and the November election could impact it, so stay tuned.
So you could give me $15,000, Kurt? And
I could, but it would be taxable to you.
Oh.
It would be taxable to you, yes.
Oh, okay, that's fine. I'm okay with paying tax on $15,000 if you want to give me $15,000. Just throwing that out there.
Think about it. All right. How do we transfer assets? Well, there's three primary ways that I see. Death. It's sometimes the easiest one to deal with, only from you don't have to deal with who you're giving the assets to. Just outright gift. Here's $1 million to my son or to my daughter. Generally not our preferred means, either that we don't know that the next generation is prepared to manage that wealth on their own, and or we want to think about protection from creditors or potential divorce. So we look to do a lot more in the transfer of assets through trust. As I mentioned, it gives us better control, it gives us better protection. Depending on jurisdiction of where you create a trust, certainly there's some privacy potential as well. So we'll focus our time here today on some trusts.
Yeah, we do a lot of work in this area, Kurt, and I think we get the clients a very good result using this process. Yes. And doing valuations to do it.
So it looks like we have another polling question for those looking for CPE today. Now is a great time to look at the screen. How much can I give annually to someone without accounting against my lifetime exclusion? $15,000 per person, as much as I want. Why would I give anything? So we'll take a few moments here and you can answer these questions, and then we can move on. If you hire Eric to do a valuation, he can get the discounts down pretty low, so we probably pass a lot more on.
Get the discounts down low.
Yeah, let's get them, or high, discount. Whichever way we're going. Yeah, that's true.
You want to do an appropriate valuation for an appropriate discount.
And like 10 more seconds, guys. We good? Get your answers in. 5, 4, 3, 2, 1. I think we're good. Let's close that up. Everybody should get this right. Cool. The vast majority of you did share the $15,000 per person, which we had just stated. So thank you for that. Let's get back to talking about trusts. Basically, two types of trusts you need to think about. You can think discretionary versus directed. Old school discretionary, think big bank. They're the trustee. They manage the assets. They make distribution decisions. They do it all. A lot of families that we work with don't necessarily prefer that model. They like a little more control in their planning. So we look at what's more modern. It's called directed trusts. Actually, if you want to just move to the next slide, I'll walk through that. So a trust basically has three areas of focus: administration, and investment oversight, and distribution decisions. In the directed one, the trustee just focuses on being administrative trustee. So you can see some of the things that are outlined in the slide that they would do for daily, weekly, monthly, and annual type administrative responsibilities. However, there are two other committees that are created with other individuals in those roles. So you'll have an investment committee and you'll have a distribution committee. Could be the same, could be different people. And they'll make those decisions, and they direct the trustee to invest in a certain way, or to what they're able to do as far as if monies are sent out to a beneficiary. So you have a lot more control as a settler of a trust, and we just continue to see that being the preference for families that are creating trusts today. Next slide. Issues to consider when creating trusts, are we making it irrevocable so that we're trying to get assets out of our estate versus a revocable? We'll talk about that more. The settler, who is that? They create the trust. Beneficiary, who they are, who will they be? Your trustee, is it an individual? Do I use, my brother, my best friend? Do I look to a corporate trustee who's in the business and understands the issues, or might be able to extend beyond a person's lifetime? Very important. And then grantor versus non-grantor concepts as to ultimately who's paying the tax. Typically, are we getting it flow through the grantor back to the settler of the trust, or are we trying to have the trust taxed at its level? Types of trusts I wanted to talk about. There's the grantor trust concept. There's two things. One's grantor retained annuity trust, or a GRAT. And then there's intentionally defective grantor trust, very similar. Beneficiary defective inheritors trust, a little different wrinkle there. Incomplete non-grantor trust, the life insurance trust, some charitable stuff, and the revocable. So let's move on, and we'll get into the weeds here quick. Grantor trust, settler treated as owner of the trust for tax purposes. They retain certain powers that triggers that to be treated as a grantor. We purposely would want to do that if somebody's drafting a trust. It might be the power to replace, really substitute the assets is one we see frequently that allows us to get grantor status. And it would be an irrevocable trust, meaning that we're moving the assets from the settler's personal estate into a trust so that's not part of their taxable estate down the road. So let's look at the GRAT. This is basically simple. I would say I have an S corp or partnership. I'm simply transferring assets out of my name to the trust in exchange for a promise to pay me back an annuity over a set period of time. Could be 2 years, could be 10 years. That's not seen as taxable, that event. And basically what we're doing is called a freeze technique. We're taking, let's say, 5 million of S corp stock in exchange for 5 million coming back. We're hoping that 5 million of stock grows to be 10 million, 15 million, something significant down the road, and that growth is outside of the estate. So we'll look at the next trust, which is similar. Defective grantor. In this case, you're selling your interest to your trust, and again, not a taxable event for income tax purposes, but we're again just trying to move assets out and planning for next gen. Could be part sale, part gift, depending on how you wanted to structure it. Again, freeze technique is here that we're trying to grow those assets out once they're transferred outside of our state, and it would be irrevocable. So the beneficiary or defective inheritors trust, or also could be called a 678 trust. This one's a little different. In this case, say I have my business ownership. But I'm not seen as going to be the settler of this trust. Actually, maybe I go out and I get my mom or my father to create a trust with me as a beneficiary, and then sell my interest into that trust. Again, not a taxable event for income tax purposes. I get to retain benefits of the assets generating potential income for me to have distributions taken out. I, as a beneficiary, pay tax in this situation if it's structured the way we normally see it. Again, we're trying to freeze that value of what was in my estate and move it outside, so for future growth, and it's irrevocable, which allows it to be outside of my estate. A complete non-guarantor trust, very popular in the country. Not an estate tax planning play, really. It's more a state tax strategy. You see this in some high income tax jurisdictions. California's highest rate is 13%. So you see people will look to transfer assets out of their individual name into a jurisdiction, say like South Dakota, owned by a trust, and they'll have a future sales event that can potentially reduce that state tax obligation that they were looking at. So we see those a lot. It can also have some protection from creditors, obviously moving out of the individual's name and putting it into trust. So pretty popular deal. Pennsylvania, 3% rate. Probably don't see this as much planning around this area, but certainly can. It can be looked at. Let's move on. I just wanted to put in here real quickly, just charitable trust planning. There's really two types you'll see in the charitable remainder trust or charitable lead trust. Basically, the distinction between the two: transferring assets in, having them grow in these charitable trusts. Charitable remainder trusts, for example, does not pay tax. So we grow these assets. We're either paying to me as the settler of the trust for a period of time, and then whatever remainder of the growth over and above what I got paid gets sent to charity when it's all said and done. Or the other way is I put a big payment to charity up front and over time, and then the remainder will come out to the beneficiaries of that trust. So it's a good way to work on your estate and also do some charitable planning, and they can have some very favorable income tax friendly rules around that. Last, I just want to highlight revocable trust. Purpose of that is you're not really looking to get assets out of your estate. The reason it's revocable, it keeps it in your estate and you're still seen as owned by you. The reason you look at it is, unlike a will, you can avoid some probate costs, particularly for high net worth individuals and what their locality is. Those costs of probating a will can get fairly significant. And it's not recorded in public documents like a will, so you have some privacy around that. Again, people like to tend to prefer not to have all of their family's business known when the will gets probated. So very, very common tool. You see that a lot, and something that you should definitely consider. So we're getting near the end here. Let's just think about the benefits of trust as we talk through them here briefly today. Estate planning, certainly whether you have a taxable estate or you just want to make sure that you're managing your affairs properly and moving assets to next generation in a way that protects them from an asset protection aspect, and also ensures that they're not spending it all down on new cars or whatever their habits might be. Control, certainly by using trust, you get to create and control some of who's overseeing it and timeline of what gets distributed out. And depending on jurisdiction, there can be some privacy benefits again. So big fan of trust. I think that's it for today for me. Certainly, as we think about it, you can see we can help in a lot of ways, from income tax planning to estate planning, business valuation. Eric does a great job in that area, and clients enjoy working with him through that process.
Yeah, and given all the factors that I discussed with COVID-19, now may be an opportunity to transfer some value to either second generation or get it out of your estate through gifting possibly or into a trust. Because the value can be down. It might be temporarily down, but chances are the COVID-19's impact has an opportunity to reduce value. So right now might be a very good time for effective estate planning. Certainly, maybe given some of the tax things that might change in the future, is you don't want your exclusion to be reduced as much as it could be in the future. So we just point out that, you know, there's opportunities we believe right now for some really tax efficient estate planning purposes, you know, through valuation and gifting and into the trusts. But yeah, now's the time to look at it. We did have one question that came in. It was, will there always be a positive or negative valuation impact with COVID-19? And that's a good question. Usually there will be, but I have a client that actually might avoid it. Now, think about this. I did a valuation for them as of December 31st, 2019, and COVID-19 was not known or knowable as of the evaluation effective date. So you couldn't factor in any COVID-19 factors into that valuation. And now everything also, if you remember from my presentation, is that valuation is forward looking. So I looked at 2020 on as if we knew nothing about COVID. Okay, so now we go to the next year's valuation. If I value them at the end of 2020, and if they're part of an industry where that has fully recovered from the COVID, or that revenue is expected to continue and profitability and cash flow is expected to continue as normal, I'm considering from 2000 and the end of 2020 on, so it's 2021 on, they might not show any impact for COVID. So in their instance, there wouldn't be necessarily a positive or a negative value. They may have been in an industry that it skipped the impact. And I thought about that because I do a lot of ESOP valuations as well that you need to value every year. And you know, there might be an industry that is not impacted, but for the most part, you know, I'm seeing, you know, mostly negative impacts, but then some positive impacts for industries that are, you know, in some of the boom cycles during COVID-19. Okay, we thank you for that question. Then, if there are no further questions, I think we have, you know, all the time in for the CPE, and we want to thank you for attending the webinar, and we wish everyone to have a good afternoon. Thank you.
Yep, thank you, Eric, for your guidance today. And yes, again, on behalf of everybody at McKonly Asbury, thank you for joining us for the webinar. If you have any further questions regarding today's presentation, please feel free to reach out to one of us, and we'll be happy to assist you. A recap of today's presentation will be posted on our website in a few days, and for those who need CPE, those certificates will they'll get sent out within the next 2 weeks. Thanks again. Have a great rest of your week, and don't forget, November's elections can impact a lot on taxes, so be prepared to think about what you're doing between then and the end of the year. Take care, everybody.